Welcome back, everyone, to NYU Grad's Daily Podcast on Tuesday, December 5th. I want to make an announcement. We have crossed over 1,800 subscribers. Slow clap. Thank you very much for going on this journey with me. As you know, I started this with great trepidation on the July 4th weekend. Not sure if anyone would even care to listen. So it's been quite a ride. 2023 being featured twice by Substack, having recommendations from Doomberg, Herb Greenberg, and Adam Taggart is just an honor to me. And for the subscriber base and the community to have such a high engagement rate. I think right now I'm averaging about 35% engagement rate on the podcast and posts and Substack notes. So thank you, thank you, thank you. I figure while the market is kind of just cruise control, I wanted to take this opportunity and thank everybody. I was also thinking about the promotion that was going on for Black Friday, Cyber Monday. And because it's so light as far as trading content, right? Because like everyone is kind of, checked out for the rest of the year. I'm going to extend it just to keep it open till Jan 1. So anyone who subscribes and pledges by the end of the year, by Jan 1, I will manually note that you are due a 33% discount once the premium paywall goes up. It seems like it will definitely go live in 2024 because my whole schedule was once we get to about 3,000 total subscribers, I would launch that service, and we're knocking on the door of 2,000 already. I have a sneaky suspicion that we'll get to 3,000 in Q1, early Q1 of 2024. So with that said, let's jump right into the markets. It was I would say a heavy headline-driven news flow today. There were PMI numbers that came out this morning. But I was laser focused on yields. What did I tell you guys? I want to sound like a broken record because you have to be consistent. You have to have a game plan. There's not one way to make or lose money in the stock market. There are many hundreds, thousands of ways. What works for me is to look at breadth, to fine tune some of those barometer metrics depending on the macroeconomics and where we are, right? Like I remember in the early days of my trading career, very early on, the Fed was never part of my top of mind for me. Like, I didn't really care about rates. It was much more about earnings and news flow, options activity. But right now, it's all about the Fed. It's all about the 10-year yields. I only say that because the Magnificent Seven, while some of them have lost the 50-day moving average, they're not crashing, right? They're stable. Whereas in, like August through October, the Magnificent Seven were crashing. And Microsoft was holding up the entire world. So right now, that's not happening. So I'm not worried about the Magnificent Seven yet. And I'm not worried so much about breadth because every day, new highs outpace new lows. So I am laser focused on yields. And yields, unfortunately, are 100% controlled by the narrative of the Federal Reserve, Jerome Powell, and what the media, the financial press, interprets his words, the tie he's wearing, the squinting he does. Did he fart on stage when he talked? It's really ridiculous, but that's literally all that's going on. So you have the Fed, who apparently is pulling back liquidity if you look at the M2 money supply. But on the other flip side, you have Janet Yellen, who used to be on the Federal Reserve side. You have Janet Yellen, who's now on the Treasury of the U.S., and she's spending. So with one breath, Jerome Powell is saying, I'm going to be tough. I'm going to be Dirty Harry, and I'm going to fight inflation, just like my hero, Paul Volcker. Right next to him is Janet Yellen spending, offsetting any of these rate increases. And, when you take a look at the yields, although the Fed did not cut, in a month's time, we basically have had a 100 basis point cut in the 10-year yield. Let me repeat. In 1 month, we went from 5% to 4.1 on the 10-year yield. So regardless of what Jerome Powell and the Fed have said about fighting inflation, they have cut 100 basis points through whatever mechanisms that may be. And we have had one of the largest November rallies in history. The only one that was stronger November was during COVID in 2021, when they just opened the floodgates of liquidity and were giving away Lamborghinis basically to anyone that said they were a small business that had employees. So yields are super important. Yields today at the 10-year closed at 4.17. It was, it just looks kind of like the VIX chart. They are really, really pressuring yields. In inverse, bonds are going much higher. So when yields go down, the dollar goes down because they're at parity, they're correlated. So when the US dollar goes down, risk assets go up, gold, silver, commodities go up because it takes more dollars to buy those assets. So that's really all that's going on right now. Okay? So I am eliminating a lot of the headline fatigue for you. That's literally, if you just put the 10-year yield or the ticker symbol TNX on your phone or your, Charles Schwab, E-Trade, TD Ameritrade, and just watch the 10-year yield. If the 10-year yield is down, the market is up. Vice versa. That's really it. But let's dig a little bit deeper. I digress. I really went off on a tangent today. I'm just passionate about this. It's so obvious to me. So the new high numbers today were 266 versus 149 new lows. So that's good. A little bit tighter than yesterday, but we're still, 1.5x pacing higher for new highs and new lows. That's good. We had 29% advancing and 66% declining. Not good. We have 25% of shares below the 50-day moving average, and we have 43% of shares below the 200-day moving average. Markedly better than where we were a month ago. I noted yesterday we were having trouble with the Magnificent Seven. Today was a lot better. So we had Microsoft up 0.92%, Apple up 2.11%, Google up 1.3%, Amazon up 1.4%, Tesla up 1.3%, and Nvidia up 2.3%. So again, as I said, there's nothing alarming about the Magnificent Seven, so you don't have to really pay attention to them right now. Okay? When you take a look at the group sectors, technology-led, again, that's a bullish impulse. If you see industrials or consumer cyclicals or defensive leading, that's bad. But today, technology led up 0.5%. Then you had communication services after that. On the back end, the least or the worst performers today were energy down 1.47%, basic materials down 1.3%, industrials down 0.95%. Just taking a look at another thing that I want to, and that's pretty much it. I could end this show right now, but I want to give you guys some more nuance, okay? Because we are very, very overbought. And it's right now December 5th, only like 2 full weeks of trading left in the year. I'll be surprised if anything happens, okay? But if you look at the the S&P 500 VIX ratio chart, it is at a lifetime high. So the SPX VIX ratio chart looks at the S&P 500 versus volatility. And this is a good measure of either being overbought or oversold, and how much risk is in the equity markets in terms of volatility, price and volatility. What this is telling me is in the history of the S&P 500, this is the lowest volatility and the highest S&P 500 in relation to volatility ever. Ever. So my point is, this is not a time to go initiate new long positions at the end of the year, buying new AMC stock, buying new Carvana stock, buying new Tesla stock. This is not the time to do it. Because volatility is smashed to lifetime lows, this is the time to hedge your bullish portfolio and buy insurance. Again, I am not your financial advisor or CFA or CPA. Talk to your financial advisor. Ask them about risk mitigation and managing risk, buying some insurance, because we are at nosebleed levels right now, okay? Santa Claus is going to come down your chimney with a big nosebleed, and you're going to have to clean that up because it's really high right now as far as the risk on the upside. With that said, keep a very close eye on the 10-year yield and yields in general. But take a look at some of these animal spirit stocks or asset classes that I watch. So when things are getting a little bit too overextended, I look at things like Bitcoin, Ethereum. I look at ARK investment with Cathie Woods. I also look at a few others, like at the IGV, which is the software ETF. But Ethereum is breaking out. No doubt about it. Ethereum broke out of its recent range, and who knows how high it's going to fly, but it's just animal spirits are on. It's YOLO, you only live once. It's back. And then you look at ARK investment. It hasn't broke out of its range yet, but it's right there testing. So keep that on your watch list. Another one that's recent is AFRM, Affirm Holdings, the buy now, pay later. If you are a consumer, if you can't afford it and you're maxed out on your credit card, but you really want that coat or you really want that Rolex and you just have to do it, and you have that urge to do buy now, pay later, 4-6 interest-free payments, I'm urging you not to do it. This is how these financial institutions are basically going to make your life a living hell in 2024. You want to reduce your debt right now. Don't go into this crowd trying to increase your debt load going into 2024. That's really all I had, but I'll go through rapid fire what was strong and what was weak today. On the strong side, you had Hovanian, K. Hovanian, the home builder, up 8.9%. If you're buying a brand new construction home, raise your hand, leave a comment. Let me know what city you are buying a new home and what that experience is like. You have TZA, which is the inverse of the Russell 2000. That's up 4%. Shopify up 3%. ARM Holdings, which is the SoftBank unicorn chip maker, up 2.6%. I roll my eyes anytime I see a SoftBank company because I've worked at a SoftBank company and it's a shit show. Just look at WeWork. You have MongoDB up 2.5%. Ferrari up 2.43% at $362. NVIDIA up 2.3%. TLT up 2.15%. Apple up 2.11%. That's going to be winning the sale of the bulls when you see Apple up 2%. On the weak side, you had Wayfair, e-commerce furniture retailer, down 4.6%. CarMax down 4.3%. TBT, inverse of bonds, down 4.25%. Sprout Social down 3.5%. Lyft down 3.3%. Carvana down 3.2%, but it's been up like thousands of percent. I'm exaggerating here, but not so much. PayPal down 3.22%. MGM Resorts down 3%. Kura Sushi down 3%. VinFast Autos down 2.97%. And Instacart down 2.79%. So this is just a sampling. I hope you had a great day. I will see you guys after the Wednesday session. Thank you so much for all the new subscribers. Just as a quick reminder, I am on X, but I much prefer to promote and tout Substack. And Substack has a competing, better product called Substack Notes, where I will post every day, intraday, my thoughts when pertinent, and it doesn't have the hate algorithm. And I think just people in general are smarter on Substack. So check out Substack Notes. I am also there as well. And just as a quick reminder, you can get this podcast on Spotify, Apple Music or / Apple Podcast, Amazon, Google Podcasts, or any podcast platform that you like to frequent. Just bookmark me. It would mean the world to me if you could do a kindness and just like 5-star the podcast and maybe leave a decent review. It doesn't even have to be great. Just give me an honest review of why you listen to this podcast, and it would do wonders for the algorithms. It's also available on YouTube as well. So wherever you consume the content, I highly implore you to just give a decent rating, an honest review of why you listen to me rant every day for 15 minutes. So I will see everyone after the Wednesday session. Have a great one and have a good evening.